So it's all about skills. I can't tell you what to do, but I can tell you how to think of the things that are presented to you, right? Because there's a lot of confusing information. And the mainstream media, I can basically know that the person who's talking is a complete moron because I can just go and do my due diligence against what somebody is saying and just know. All right, let's go over what I think is happening with GME. All right, a gamma squeeze is not you squeezing your partner, holding on for dear life. It is not that. All right, I'm gonna do a Hulk smash hand. So gamma squeeze is a Hulk smash event. So derivatives definitely do affect the market. Let's go look at what derivatives I'm talking about. GME has options that are being played on them at all times. And these are contracts for delivery of the underlying. What does that mean? It means that they have to deliver stock. So if you have to deliver stock, then this product is actually tied to the value of it. So let's look at volume and open interest. It's not as big as I remember from the original GME days, but this is a fuck ton of volume today. 6,910 options. Do you know how many, who can tell me quickly, how many shares of GME you control with 6,912 options? So you control 690,000 shares at the 200 strike. So let's look at the overall volume of GME today. 2 million shares traded, so on average. However, you're basically controlling a quarter of the average volume with those options. So that may not be the same person, but you can make a simple connection to understand that options can definitely affect the price in large quantities. Okay, because we have a simple measure that we can go. So first off, in the Hulk smash event, you need to make the connection that shares traded affect the stock price, right? Then second, how do we know enough shares traded are enough to move the price? Well, there's a simple formula that you can use to understand if it is affecting the price, right? So every time you look in an article, this is a very simple skill that'll help you even beyond explaining to you what a gamma squeeze is. It's a very simple skill. So when people say, okay, hedge fund X or person X traded 2 million shares, or you read a disclosure form saying that somebody is a beneficial owner that owns 5% of the company, or a 13F where a hedge fund says that they own X number of shares, how do you know that that is a significant event for that stock? Well, this is this formula. So it's all about skills. I can't tell you what to do, but I can tell you how to think of the things that are presented to you, right? Because there's a lot of confusing fucking information, right? And the mainstream media is, I can basically know that the person who's talking is a complete moron because I can just go and do my due diligence against what somebody is saying. For example, CNBC is saying that this is retail, and just know, right? Because 2.2 billion volume, you can look up how much the volume is on retail trades, right? Because there's a lot of information about that. And so I can make a connection between the volume that I'm seeing out there and knowing that there's no way that they can encompass that volume. So I can know that the assertion that it's just retail traders is a complete and utter farce. Do you see how you do that? And then you go throughout all the content that you guys consume and see, and then you can decide for yourself what is valuable to you in this fucked up market and your journey into learning how to think about investing, right? It's gonna be a thing. Okay, so let's go over this formula. Nobody likes formulas, but whatever. We're doing it. Okay, shares traded. So, will it affect the stock? Is the question we're trying to understand. So it's 5% times the ADV, which is the average daily volume. 5% times the average daily volume is your share count. If the shares are greater than the thing you want to determine if it affects it, then you know it could have an effect on the stock, right? So let's do the math with the 6,900 options, right? So 6,900 options is equal to 690,000 shares. So where do we put that? We put that right here. Now let's calculate 0.05. And all you have to do is, if you have TD Ameritrade, all you do is you put up a study and you do lower. Yeah. Volume average. Okay. It'll calculate the average daily volume as a running graph on 50 days. Now, because GME has done some fucked up shit lately, we're going to say, you know, let's shorten this a bit to calculate for the last 10 days because it's more fair, in my opinion. Now, you can do it any which way. So what you're doing is you're looking at this day, and you have to change it to day so that way you can get daily bars, right? And you just go over here, and the average daily volume for today is 24 million. So now we have 24 million right here is the average daily volume. You see that? So we do 5% of that is going to give us the number of shares. So we'll just do that real quick, right? It's not a ton of math. It's really easy. 5% times 24, 24 million gives you 1.2 million. Is that greater than 690K? So that block of options necessarily would have a really tough time moving the price of that stock. See that? It is just that easy. Congratulations. There's a lot more complicated ways to do it. It's called the Emmy-Hood liquidity factor or something like that. I have to look it up. But this is a simple way and a simple approximation. There's a website if you're interested in these kinds of basic calculations. It's like breaking down the math of finance. The website is literally called BreakingDownFinance, and it's really cool. I think it's first you go to Investopedia. Your second place is this. I just went out to the volume today that's been traded on. And look, and now it's 7,693. I just went out to one strike of 200. And I'm just looking to see if this group of options would affect it. Right? So you need way bigger numbers. And I'll show you how to start thinking about gamma squeezes. So it's a big onion that if you stay through the whole thing, you'll start to really have some ways to concretely understand the shit that's being thrown at you. And none of the reporters are going to help you with this because they don't trade, because they have no skin in the game. They have nothing that makes them accountable for this shit that you say, right? Imagine them as people who like to run their mouth, right? And they don't have parents there to slap them and just say, you know, stop mouthing off at people, you know, to give them manners, right? It's the same thing. They don't have that investing record to show them that, hey, I really thought these, you know, the retail traders were really affecting the stock. Well, it turns out it's options. It's just the options market, you know? And so in your investing journey, the market will tell you when you're fucking wrong about shit. So that's one thing you need to realize. So that way you can understand the gamma squeeze. Okay? So that's one layer of information we needed. Why the 5% seems a little arbitrary. Well, it's like any rule of thumb. The appropriate way to do it is with the Emmy-Hood liquidity measure. But they're just good rules of thumb. It's about 5%. Okay, so that's a low touch trade. So now you understand how to understand if something is actually affecting the price of a stock. And you can see that it takes, for GME, it would take 1.2 million shares for something to really affect it. Do you see that? Number two, the second thing that you need to understand is hedging options to be able to understand this concept truly. So hedging, you need to understand how to hedge an option. Okay, so let's say, so if you sell a call, it's really risky, okay? Because it exposes you to infinite risk. So if you sell a call, what you need to understand is how to hedge it. So it all depends on the delta value. When you hedge an option, it is entirely dependent on the delta value. So let's use the same example. Wow, it's 8,000 now. Okay, so what we'll do is we'll add in here delta. Okay, what is delta? All it means is how much it's going to get affected by GME moving, right? So if we're looking at the delta value of 39, it just means for every dollar that GME moves, the option moves 39 cents. So, and it doesn't move a dollar for dollar, right? Dollar for dollar movement would be down in the 1 delta, okay? Because you're going to need to know that the next part. So to hedge it out, if you have 39 cents movement for $1 movement of GME, then all you need to know is the same. That's a ratio, right? What are ratios in your life, right? Every time you tell your significant other to fuck off, you probably owe her 2 flowers or maybe 1 flower or 10 flowers to make up for the shit you did. That it all depends on what that fucking ratio is. So if it's 39, that means if you sell 1 call at 39 delta, you have to buy 39 shares of GME to completely hedge out. Does that make sense? It means that when the option moves, your P&L doesn't move. And we're going to put that in red. It doesn't move. It stays completely zero. Because that's what a market maker does, is they want to make money on the spread. See this dollar spread? But they don't want to be affected by GME moving into infinity and beyond. They just want to buy and sell you like a middleman, right? He only wants to make a little bit of the money. He doesn't make GME. They don't make the widget to sell you. They only get a little bit of margin, right? A little bit of money. So now 3 for the last piece so you can understand a gamma squeeze. So now what you need to see is when a gamma squeeze is on, right? Is think about this delta, right? What is gamma? So gamma is like, for example, the acceleration of a car. Delta is like the velocity of the car, right? So all they're doing is hedging out the velocity, right? They don't want to get hit by the car, so they're saying, like, let's say you were running with the car, right? If the car is going at 70 miles an hour, what do? You make sure you're running at 71 miles an hour so you don't get hit by the car, right? So does that make sense? Delta is basically these market makers moving out of the way, right? By hedging, they avoid the storm that is GME coming at them. The squeeze can happen at any time. It's called pin risk. It's when options aren't open, and that's why when they shut everything down, it's because they were afraid of the weekend. Okay, so gamma is instead that X factor, that asshole who's in the car who's pushing down the pedal, right? Because at any one time, you can see that the velocity is 70, right? But what happens if this asshole is accelerating? So you have to adjust your speed up to $71, to 71 miles an hour, right? But what if he's in a fucking Tesla and he's putting his foot down on the gas? Well, that's the acceleration that you have to be careful of, right? That's essentially what's happening in the options market is when you get a gamma squeeze, it's the potential for somebody to be on that accelerator. Because delta is just the acceleration of options pricing for GME moving. Doesn't matter how fast you run from the Hulk, because he's going to fucking get you anyways. So now, how do you see Gamma? So we're going to pull up Gamma. We're going to look at it here. So each line that we're in here is a different expiration. So purple is the ones expiring 26 February of 21st. Near-term expiring ones, look at the Gamma that they have, right? Look at this crazy Gamma. Remember that guy with the accelerator on the pedal to the metal? That's the near-term ones. If they go into the money, you get paid like crazy. And similarly, as the expirations go longer, the Gamma reduces, right? So what you need to think of it is, where is the Gamma squeeze, right? It's most likely in those near-term options, right? Because we're seeing it right here, that it's almost 0.01 for the near-term ones. In the calls, so we can move to the puts. The puts are way more profitable. Holy shit. If GME accelerates towards the down movement. Okay, so we saw Gamma, right? Now, how do you see if a Gamma squeeze is on? So basically what you do is you go into, so now we saw where we think it is, but this is saying it's in the near term ones at the 100 strikes, the 100 to around 150 strikes, 100 to 150 strikes, okay? So we're going to go look over there. And what we're going to do is we're going to pull up volume. So look at where most of the volume is, right? 100 to 150. It seems like the calls are really doing that. So, okay, so to me, this is almost from the 100 to 200 strike range. So let's go 100, which is here. I would say it's really 120 it's starting. 120 to 200. See where all the volume is, right? So what I want you to do is to add up, you would add up all those numbers and see if that is really starting to affect the stock, right? So let's say 1K, 2K, 5K, and it's a rough number, okay? 2K, 5K, 11K, 12K, 13K, okay, another 10, so that's 24K, 25K. So we did this again, so 25K options times 100, it's going to get you the total amount of shares. 2.5 million. Okay, so we did the average daily volume. So 2.5 million. This really is a high touch trade. Because remember, we already calculated the 1.2 million. So let's go look at GME for today. I think it's really bizarre that if you look that at 120 they're pinning, right? Look at where the volume is. The volume slush starts. Look where the volume slush starts. At 120. Look at the price movement today. It's flooring around 120. That's called a Gamma squeeze. The options are now affecting the price of it. Okay, so the wave of realization should rush over you, and everyone in chat should be saying, "Oh my God." Okay, so what you can do is go in here and start to see, what you want to see is, so basically I'm teaching you options flow, okay? So what you want to see is, you want to come here, so we want calls, we want the front series, and we want quantity minimum to be, I don't know, 300. See how much there are there. I'm not saying it's going to pop off. You still have a little bit of work to really... You would have to have some kind of tool that helps you really understand options flow. But you can see it start to build in certain places. So let's see the strikes that they're buying around. So 220, 130. Let's get both. Somebody bought 1,000 $10 puts for a penny. Interesting. Nothing really that big. I would have expected more. So either someone's accumulating or because that's a lot of volume for one fucking day. 10,000 in the 200s. So basically you can start to build, right? And so what you need to compute is where gamma is the highest. And those are the places where the squeeze is happening, right? So remember, with any of these things, it's not a probability. It's not a certainty. It's a probability. So it's a probability, not a certainty. So all a gamma squeeze is going to tell you is that the volume of options around certain strikes is going to really accelerate, right? It's going to be larger than average movement, especially around expiration dates, around at the money movements. So let's say GME goes to one of these high volume areas. It should have a huge acceleration event coming up to those strikes. That's what remember the guy pushing the pedal to the metal, right? That's what it is. It's huge acceleration events. Gamma doesn't tell you direction. It tells you the acceleration and the sheer utter pushing power that this thing is going to have when it comes around those strikes.